Good morning and welcome to this, Thursday, October 5th, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we prepare for the market open. Right now, we got futures down across the board about 0.2%. Crude oil prices down another 71 cents. We're back below $84 a barrel. This is why, personally, for me, I find it really difficult to invest in the energy space because energy is very reliant. Energy shares very reliant on the price of crude oil. And it was just a week ago, seems like maybe a little more, that we were up over 94 or near $94 a barrel. Now we're back down below $84 a barrel, and the XLE's made a complete U-turn on the chart. So we'll see what happens there, but at least for now, crude oil prices down again. US 10-year Treasury yield, I'm showing unchanged this morning. Obviously, I think the market hoping that cools off a little bit. We did get up around the 4.80% area. Now we've pulled back just a little bit, but we got a lot of news coming out this morning. Initial jobless claims was expected to come in at 210,000, came in at 207,000, so a little lighter than expected. I think it would be better for stocks if we'd start seeing that number ratchet up a bit, but it's held pretty low and has been pretty stubborn down around this 200,000 level. Tomorrow, we've got jobs report. I know we had the ADP employment report out yesterday, which showed a little bit less in terms of jobs than what the market was expecting. Probably would be a good thing to see that again tomorrow. The number that we are expecting on non-farm payrolls is 160,000. Private payrolls, 150,000. The unemployment rate is expected to actually drop a little from 3.8% to 3.7%. And the average hourly earnings expected to jump from 0.2% rise to 0.3% rise. So those are some of the key numbers that I'll be watching tomorrow to see whether or not they come in line, whether or not we have a surprise that could impact stock prices and bond prices. But for now, we wait. We wait on that jobs report for tomorrow. Yesterday was a pretty decent day overall for the market. Let's go ahead and take a look at the action yesterday. And what I'm going to focus on a little bit today is just, since we had the Fed meeting that concluded on September 20th, which was 2 weeks ago yesterday, we've had a lot of talk. Of course, the Fed started it by saying, hey, we're going to keep rates higher for longer. You should expect rates higher for longer. And so immediately everyone wonders, well, what does that mean? What's that going to mean for the stock market? What's that going to mean for my portfolio? Well, now it's been 2 weeks in. And so we do have an opportunity now to at least take a look at the rotation that's taken place. So that's something that we will take a look at toward the end of the show. But yesterday, on Wednesday, we had the Dow Jones Industrial Average gain 127 points. That was up about 0.4%. S&P 500 up 34 points. So that was up about double the Dow on a percentage basis, up about 0.8%. And the Nasdaq was up 210 points or 1.45%. While mid caps and small caps didn't do quite as well. Mid caps up about 0.5%. And the Russell 2000, which was down much of the day, did come back up and printed what looks like a little bit of a hammer. I'd like to have seen that across the board on all the major indices. Didn't really see that. But the Russell 2000, which was down much of the day, did come back and close just slightly higher. And the transports finished up for the day, but remain in a pretty steady decline there. Looking at the sectors, we saw some strength in areas that we'd like to see strength in on a rebound. Discretionary popped about 2% yesterday. Technology 1.25%. Meanwhile, as I mentioned at the open, crude oil prices dropping. Energy shares down more than 3% on Wednesday, dropping $2.78. I mean, we were just up to 92.5, 93. Looked like breakout, here we come. And now all of a sudden we're back down below all of our moving averages. The PPO's back down to the center line, actually just breaking below that center line. So this is the problem I have with energy. It's just so volatile. I mean, not that all stocks aren't volatile, but energy, for no reason at all, we could be in a bull market, bear market, whatever. And just depending on some of the things happening around the globe and what happens to crude oil prices directly impacts a lot of the shares in that space. Autos had a really good day yesterday, gaining over 5%. Tesla moved back up above its moving averages. We're seeing a lot of this in the auto space, moving above moving averages, moving below. To me, that is just the definition of a trendless market. So yeah, it looks good today that Tesla has now climbed back above the moving averages. But by the end of the day today, who knows? We could be right back down below. We're really in this consolidation phase in some areas. Other areas, it's easy to argue we are certainly downtrending, especially if you look at the daily charts. Here's a little bit of a surprise. The hotel REITs actually up 2.67%. I can't remember the last time that I talked about REITs and leading industry groups all in the same breath. But here we do have the hotel REITs up not too far from 3%. They do have a double bottom in play, actually almost a triple bottom going all the way back to the beginning of May. Will that hold? That's a really good question because many of these real estate stocks are getting hit. The higher interest rates certainly not helping. I think commercial real estate in particular struggling. So we'll see what happens there. But hey, we'll take what we can get out of that group. At least we had one good day. Media agencies also pretty strong day, up about 2.5%. I didn't show the laggards on here, but you can imagine most of them in the energy area for Wednesday. Moving on, 10-year Treasury yield. Again, the only report out this morning of any significance, initial jobless claims, which did come in a little bit below expectations. And the reaction in the bond market now, what I'm showing is, well, we were up about 1 basis point. Now we've dropped a little bit here and we are back down. I would have expected with a little bit, with initial jobless claims coming in a little bit below expectation, I would have thought maybe we'd see a little bit of selling in bonds, a little bit of a movement to the upside in the yield. And that's what we saw initially, but we have come back down. Again, this would be welcome news for the bulls if we could pull back here a little bit on the 10-year Treasury yield. So far, so good. The big report's going to be out tomorrow. So we got the jobs report out tomorrow. That's going to be big for all of the major indices. The S&P 500 still in a downtrend. Yesterday was nice rebound, but the PPO doesn't look that great. We still got to get back through 43.05 on a close. Recent high open was up at about 43.30. Give you that number. 43.28. And you've got the falling 20-day EMA, which is falling pretty rapidly, and it's now at 43.47. So you got a lot of overhead resistance now, short term, from that 43.05 level up to 43.47, and that 20-day moving average is going to be dropping every day, at least until we get some more strength going on. So I think that 43.05 level, maybe just above there, continues to be the key area to watch in the very near term. To the downside, I mean, we're broken on the daily chart. I've said before, I think maybe somewhere around the 4,200 level could provide some support should we get down there. I think that also would be a pretty good support looking at weekly charts where the 50-week moving average is coming in just under 4,200. And then when you go to the monthly chart, long term, we tend to trend above 20-month EMAs, and that's sitting pretty close to 4,200 as well. So all of this is coming together somewhere around 4,200. What would be great potentially, because I'm not sure we've still seen capitulation. Yesterday kind of looked like it a little bit. And I want to show you also a reading over at the equity only put call, or the CBOE, showing the equity only put call ratio, because that was something crazy. But I'll show you that in just a minute. Anyway, to the downside, watch 4,200, upside a little bit over 4,300. I think we're in that range right now. Maybe if jobs report's a little hotter than expected, maybe, who knows, maybe we see a negative jobs report. I don't know what the market would do. Probably not react very well to that. Even though that's kind of what the Fed wants. I still think that would be a little, maybe a sticker shock. But I think nirvana for stocks, or at least the best case scenario for stocks, would probably be job growth, but still below expectations. That's at least what I would think as we head toward tomorrow. Let's keep moving. NDX, Nasdaq 100. Nice reaction yesterday. Nice move up. We are still holding that 14.5 area where we've seen, we saw actually an intraday move below 14.5 a little over a week ago. And now hoping to hold that level if we do see some additional weakness today and tomorrow with that jobs report. Small caps, that's probably the best looking candle I saw yesterday, simply because you had new lows being forged. You can see the volume certainly was very heavy yesterday, and we saw a big reversal closing back above the open. We haven't seen that much. It will take another pretty decent day today, though, for me to start to be convinced that that's a bottom. This reversal did occur at a pretty good level down below 170. If you look, 170 down to 167.50 since October of last year, this area has been key support. Probably 168.5 there, below 169 there. Here we opened at 167.5, actually went below it intraday. Here we got down to 167.50, and now here we are again, month later, back down at 167.50 to 170 in this range. Is this it? Your guess is as good as mine. Like I said, I'd like to have seen more capitulation across the board. But this is what we have for now. It is at least a little bit better than what we were seeing, the way we were finishing on the IWM. So maybe a short-term victory for the IWM, but let's see what happens today. Transports, as I mentioned, the open continuing to trend lower. We did have a new low on transports, and we saw the transports come back up and hold the prior day's low, actually gaining a little bit of ground. Is that capitulation? Well, volume's picking up, so that helps. It does look pretty good, but we need to see some follow through. Now, before I go any further, I do want to show you this this reading over at the CBOE. So if you go over to CBOE.com and click on data and access, and then go down to market statistics, under US options, click on market volume, and then scroll down. And I want you to look at what happened to the put call ratio. These are cumulative readings. So as you get further and further into the day, it's really hard to start moving this put call ratio very much. And I want you to look 0.71, then we jumped to 0.84. We got 0.88, and then we were in this range from 0.84 to 0.89 for most of the day. And then all of a sudden, 1.46, 2.12. Huge jumps. This is the same thing that happened to the equity only put call ratio in October and November of last year. And at the time, there were some articles that came out that talked about how hedge fund managers, portfolio managers were putting on some hedges against some of their large cap stocks that they own: Apple, Microsoft, NVIDIA, Tesla, Google, Amazon, all these companies. And I'm not so sure we're not seeing a repeat of what we saw a year ago. So I've been keeping an equity only put call ratio on my user defined index, where I've been adjusting these huge spikes out. This is not panicked retail traders buying 700,000 puts from 1 p.m. to 1:30 p.m. Central Time. That was actually 2 p.m. to 2:30 Eastern Time yesterday. If we look at the S&P 500 and we look at what happened between 2 and 2:30 yesterday, I mean, we were going up. There's no reason for panic. Why would anybody panic? So it just didn't make sense. And so if you look at it, I think what's happened is we're seeing, again, these equity only put call ratios being heavily influenced by folks that are hedging. They own the stock and they're probably just hedging against downside. That's the only way I can explain it, because from this half-hour reading at 1 p.m. Central Time, to this one at 2 p.m. Central Time, you can see that there was about 1.5 million equity puts bought. And at the same time, 146,000 equity calls. Again, 1.5 million to 146,000, 10 to 1 over that hour. That's not retail traders. And so I always like to use the equity only put call ratio, basing it on retail traders. So what I would normally do is say, okay, we were right at about 0.89. The market was going up after that. There's no reason why we would have jumped up above 0.89. So what I actually will do is go in and manually calculate what the puts would have been in each of these 2 hours if we had had a 0.89 reading. I don't know that that's the exact number, but it's a whole lot closer to what retail traders are doing than what this number is going to show. 1.98. Let me show you the equity only put call ratio. Let's go back and take a look at the CPCE. And we're going to go back 20 years. I'm going to give you every day's reading for the last 20 years. Okay, why did that? Let's try this again. All right, now let's try 20 years. And we don't need all these other things here. Only thing we need to know is the individual readings. So when I pull this up, here are the readings. Now, all right, stock charts is only showing 1.11. I'm not sure the disparity. That's a pretty big disparity because you can see on stock charts we had, maybe they're factoring some of this out as well. I don't know. I'll have to verify that. But you can see last October and November, you see these readings that one of them got up to 2.40. I mean, back in the midst of a collapse in our financial system and the panic that went along with it, we never got an individual reading above 1.35. I mean, if you go back, let's go back just a little further. Well, it's not going to give us individual readings, but here 1.35. If you come over here to the end of 2015, we had that corrective phase for about a year and a half. Actually, beginning of 2016, we went down and barely set a new low on the S&P 500. But right here, you can see we got up to about 1.20, a little above that. In the middle of the pandemic, when we had all of that fear gripping the market, we went up to 1.28. I mean, these were periods when there was real fear and individual retail traders were buying puts hand over fist at the bottoms. This was not, I mean, yes, October was the end of the bear market, but if you go back and you look at the days that these readings occurred, individual days, they made no sense. I think that biggest one came on a day when the market was up. I think the S&P was up over 1%, maybe 2%. There wouldn't be fear. So I'm not sure what this reading was yesterday, but it's probably not 1.1. It's probably somewhere around that 0.89 level. And the level that's coming up over at CBOE, if you use this, it's probably not going to be a very good indication of what truly was the fear at the retail trader level yesterday. So I will adjust it and continue to use my user-defined index, which I do share with our members periodically. It's in the you can look for it probably every other week, if not more often, in the weekly market report that I now issue on Sunday/Monday of each week. All right, let's move on. I want to talk a little bit about, well, let's go over to earnings beats. And if you like the chart of the day that I talk about on here, and you'd like to begin receiving it in your email Monday, Wednesday, Friday, you can simply come over to earningsbeats.com, type in your name, email address, hit that subscribe button. We'll have you all set up. Monday, Wednesday, Friday. Again, that's when it comes out, completely free, no credit card required. We'd love to have you. Just trying to teach some of the things that I like to, or things that I've learned over the years, things I think really matter in the market. Some of it could be individual stocks that you might want to, you might be interested in trading. Of course, that's completely up to you. I always say we are not registered investment advisors. We do not advise. We are not advising anyone to buy or sell any securities. Everything we do is educational, but you're more than welcome to look at what we provide. And sometimes you may decide, hey, looks pretty good, I'll take a shot, that kind of a thing. Anyway, make sure you go over to earningsbeats.com, sign up if you haven't already. I wanted to show you today something that I showed our members yesterday in our daily market report. And this was Lennox International. I haven't been looking too much at individual stocks, mostly because the market's been coming down and most stocks aren't doing very well. So probably not a great opportunity on the long side. And I've said many times, I don't short when I believe we're in the midst of a long-term secular bull market, which I absolutely believe we are still in. So, but there are some stocks that are continuing to perform well. I would argue Lennox is one of the better ones. LII, AD line continues to soar. Price action continues to move up. Even though we've had this rough period since July, Lennox actually set a new high in the month of September. Not too many stocks were doing that. If you look at their relative performance to building materials and fixtures, you can see right there, it's one of the leaders in the group. And the overall group was at a 52-week high back at the beginning of August. So July was still going up. Beginning of August, it topped. It's pulled back, but it's trying to turn back to the upside. This is an interesting stock. Now, this is all the price action, but I'm not done. Let's look at the seasonality. One thing I was having problems with yesterday was getting images. I was having problem printing images in my daily market report. So anyway, I wanted to show this, the LII 15-year chart, and check out October, which goes up 60% of the time over the last 15 years. So that's 9 out of 15 years, averaging going up 4.1% per October. And then look at November. Check that out for a second. $15 years. Been up every year in the month of November. 15 for 50. Actually, technically, this is this 15 years includes November 2023, which we haven't seen yet. So technically, there's only 14 Novembers. Still, 14 for 14, I would say, is pretty good, and averaging 5.8% per November. So this is a stock that goes up almost 10% on average during the months of October and November over the last 15 years. I think that's at least worthwhile noting, because it does seem like history, seasonality the stock really tends to pick up as we move into October and then certainly through November. So this is one that I would keep on my radar, keep on a watch list. And if you're keeping just price charts, maybe make a note and say, hey, check out the 15-year, you can annotate right on the charts, but check out the 15-year seasonality for LII and especially November, which tends to be exceptionally strong. All right, last thing I want to do today. This is what I was talking about earlier. So now we've had 2 weeks under our belt since the Fed came out and said rates are going to stay higher for longer. While at the time we can always say, okay, what are we going to do? What do we think is the best play? Where should we invest? I mean, if rates are going to continue to go up and going to stay up for a while, certainly sounds like the bond market's not where you want to be, because folks will be selling bonds and yields will be going up. And that's what we've been seeing. 10-year Treasury yield's been going up. Bond prices have been going down. Bonds have not been the place to be in. What about stocks? Well, we know the market's been going down for the last 2 weeks, but what areas are leading during this 10-day period or 2-week period, and which areas are lagging? Because to me, that's what really matters. That's where we're seeing money rotating. Wall Street now has all this information, the big Wall Street firms. So they've got an opportunity now to start moving out of certain areas and into others based on this latest Fed proclamation. higher rates for longer. That's what they're telling us. So what does that mean? What's been working and what hasn't been working over the last 2 weeks? Well, here's an S&P 500 chart. And if we go below, I've got the aggressive groups. I've got technology relative to the S&P, not absolute performance, relative performance. So don't write in and say, wow, technology is not going up. I'm not talking about their absolute performance. I'm talking about how they're performing relative to the benchmark. September 20th, right here, was the day of the announcement. We went down, finished on the low. And then since then, you can see we gapped down and we've been going mostly lower since on the S&P 500. Since the 20th on the close, that was the low for technology on a relative basis. So the Fed's telling us rates are going to be higher for longer. The 10-year Treasury yield rises, and the aggressive growth stocks in technology blank outperform. That's what they've been doing. Technology is actually leading right now and has been since the Fed announcement. Discretionary now, little different story. Here was the Fed announcement. So that day it was here. Next couple days it went down. But since here, you can see the S&P's down. XLY has been outperforming now over the last maybe 8 days or so. Communication services, another aggressive group, outperforming throughout the period. Industrials outperformed for a while, and now they've turned back down. They're actually a little bit below where they were. Financials are ones that have taken it on the chin. Financial is going to be really interesting. We've got JP Morgan and a lot of the big banks reporting at the end of next week, starting on Friday. I know that's when JP Morgan reports. And JP Morgan's one of the leaders in the banks. Financials have not been performing well, and banks have been kind of one of the thorns in the side of the entire financial group. What does JP Morgan say next week? I think that's going to be a big report, not just a report, but what Jamie Dimon has to say, I think will either lift the banking group or potentially, if JP Morgan were to issue any kind of a warning, that would be bad for banks. Maybe it would be a watershed moment. I don't know, where we could possibly see one final capitulatory move to the downside in the banks. But you can see financials have not performed well over the last 2 weeks. Now let's move on to the defensive groups. I'm going to try and wrap this up pretty quick. Market opens in 2 minutes. Defensive groups, we got the S&P again going down. Healthcare, we've seen money rotating into healthcare. That's been one positive. And healthcare right here around the 20th. Well, it was right about here where we finished with that Fed meeting. That's where we closed that day. We're up slightly from there. So we went up, then we came back down, but we're up slightly. If we look at the rest of the defensive groups, staples down, real estate down, utilities down. I mean, if the market's biggest problem is a recession ahead, you wouldn't know it by the way we've been trading since that Fed meeting. And again, it's hard for me to have a long-term bearish picture when you see all the big money on Wall Street moving into aggressive areas since the Fed meeting. Market going down, and yet on a relative basis, we're seeing this money rotate. You want to see something even more impressive? Let me show you one more chart here, and then we'll wrap this up. S&P, same chart, 30 days. Here was September 20th. I want you to look at all of my growth versus value, aggressive versus defensive ratios. These are what I consider my sustainability ratios. So when the price of the S&P is going down, are these ratios going down, which would indicate that we're probably going to keep going down on the S&P? Or are we seeing opposite and money rotating into aggressive areas, which would indicate the downside is likely to be limited on the S&P? Here's the QQQ versus the S&P 500 rallying. Here's the XLY, XLP. Since the 20th, went down for a few days, rallying. How about the IWF, IWD? Large cap growth versus large cap value, rallying. How about the actual indexes? Large cap growth versus large cap value, rallying. Mid cap growth versus mid cap value, rallying. Small cap growth versus small cap value, rallying. Transports versus utilities, rallying. Folks, I don't make this up. I'm just here reporting on what's happening below the surface. Yes, the S&P 500 is going down. You know what? The S&P 500 went down in September, October last year. And these ratios, many of the ratios that I looked at, not just that period, but earlier in the year, May and June, when we were setting the initial low, money was rotating. We're seeing it again. So, you know, those who want to stick to the bearish theme, be my guest. I just don't see it. I see Wall Street preparing for a big advance in Q4. We'll see what happens. Anyway, let's see what the market just opened 1 minute ago. So let's just take a quick look. Yeah, we see a little bit of weakness right now at the open. The big report's going to be tomorrow. I don't know. I think if we get, I hate to say a Goldilocks scenario because it's so narrow. But it does feel like if jobs come in stronger, the market's going to have an initial reaction to the downside. And it feels like if the jobs, I mean, if we have negative job growth, I can't imagine the market would rally off of that. Maybe. I don't know. Anyway, tomorrow morning is going to be very interesting. I think it's time just to be cautious, but I still remain cautiously bullish. I am not bearish. I've had folks, somebody said, I forget the comment that was made yesterday, that I look broken. And I had to laugh. It's like, no, I'm really not broken. I'm actually pretty excited about the fourth quarter. Yeah, I'd like to get past all of this Fed speak because I don't think we're going to see the kind of selling that they're talking, or the kind of selling in bonds that they're expecting. But we'll see what happens. Anyway, that's it for me. Have a great day, everybody. Again, be careful out there. I'll be back next Tuesday for your next Trading Places Live. Have a great weekend ahead. Happy trading.